Where should you invest in 2025? We have seen just a huge sell off, 22% peak to bottom for the stock market here in the United States. The only thing that's predictable in the United States at this point is unpredictability. Businesses need predictability to gauge what their outcome looks like for the coming year. Given that, the unpredictability of what's going on here in the United States should be alarming. One of the reasons why we've seen the stock market fall peak to bottom 22% in just a couple weeks. So where should you invest in 2025? Myself, an economist, former hedge fund manager, moving overseas. Now I have my core long-term portfolio, and I'm not going to make any changes there, but I do get dividends. I do get earnings, and I do make various kinds of trades. I sort of macro manage my bigger portfolio. At the same time, I do a lot of trading. All that money, typically I would continue to invest in the US stock market, but it's not exactly favorable. Take a look at Europe. This is what I'm doing. The reasons why I'm moving to Europe is simply this. Whereas in the United States, we're seeing tariffs across the board, 10%. Who knows where they are with China? I can't keep track. That is instability. Those tariffs are going to deteriorate the outcome of the United States economic growth policies. At the same time, there's another sort of wave coming. Moody's has, in their latest reports, downgraded the overall U.S. outlook credit-wise from stable to downgrade. Now, they're still keeping the AAA rating, but we're looking at $8 trillion that needs to be refinanced in June, by the end of June. All right, given that, we're likely to see poor interest rates for that refi. This will be a drag on economic growth. Should Moody's then downgrade, this is going to push interest rates up continuously here in the United States. This is an unfavorable outlook. You got the tariffs, you got interest rates. The costs of tariffs are going to continue to move higher and higher on a tertiary basis, secondary basis, not just that initial 10% that we're seeing. Given all these factors, the United States of America basically isn't open for business anymore. The Republican Party wants to push through tax credits, tax cuts. They want to extend Trump's tax cuts. Given those scenarios, this will be a drag overall on U.S. economic growth. Take a look at Europe. They're just pushing through $1.8 trillion worth of infrastructure and defense spending. While the United States is pulling out of Europe and containing themselves, Europe is sitting there saying, fine, I guess we have to take care of this stuff all ourselves, and so they are. That is growth potential. Now, I've talked about FEZ ETF previously. I want to break this down again. I'm kind of looking at some of the bigger companies within FEZ ETF. This is sort of the S&P 500. It's the DJ Stocks ETF for Europe. Very similar to S&P 500. There's about 50 stocks in there. We're going to take a look at a list of those. I'm going to break down 3 of them so you can get a better understanding of what's going on inside this ETF, but also look at the macro picture for Europe relative to the United States. As it turns out, the U.S. stock market is down from the beginning of the year some 7-8% at this point, whereas FEZ ETF is up 15%. That's a 22% differential. Keep that in mind. Let's jump in. All right, here we're looking at FEZ ETF, which is the Dow Jones Euro Stocks 50 versus the SPY ETF. And I started this point right here, March 2020. That is the last sort of big economic event that we had. I pulled this from Bernanke. Bernanke used to be the Federal Reserve chairman back right around the financial crisis, 2008 time, and I don't remember he took over from Greenspan. But that was his big thing. He actually studied starting with the Great Depression and moving forward. This was his big thing, focusing on the latest big event, which of course also entailed World War II, rebuilding Europe from World War II. So for me, this is my starting point at this point, although we've had several starting points previous to this, but now I'm trying to borrowing from that policy, looking from March 2020, take a look all the way over. You can see that there's a fairly decent spread with FEZ ETF versus SPY ETF. Mostly, however, and dead smack in the middle, if you take a look there, you can see that FEZ ETF actually sold off more so relative to SPY ETF. This is when both ECB and Federal Reserve had to raise interest rates. The ECB has only one edict by law, and that is, of course, price stability, whereas there's a dual mandate in the United States with the Federal Reserve, price stability and full employment. The ECB only has that one. So they tend to really go after inflationary prices far more so than the Federal Reserve would, although the Federal Reserve is very cautious moving forward with regard to price pressures. You continue looking forward, you can see the Federal Reserve started lowering interest rates at a different pace. FEZ ETF kind of went sideways, and then all of a sudden there was a flip-flop. U.S. equity markets sold off sharply, whereas simultaneously we've seen European stock markets moving higher, and this is really because of the infrastructure. The big shift, and this all started roughly in 2025 January, that kind of time frame, it's really being driven by defense expenditures, infrastructure expenditures, things like this. But Europe itself has more of a Europe first, Germany first, France first kind of approach, more so than bottom line viewpoints like we have here in the United States. We don't have any bullet trains here in the US. They have tunnels going under the English Channel from London to Paris, things like this, that they're more on a collective basis, and collectively they're going to defend themselves and improve the infrastructure overall, while at the same time containing their budgets so that their deficits aren't detrimentary. Given that, compared to the United States of America, and I've seen some fairly interesting articles over the past couple days looking and saying, how did we get here? We have 122% debt to GDP ratio. Moody's is staring at this, so should you, simply because this will push long-term interest rates higher. That is inflationary in itself. Now, here's something else to take a look at. This is the euro versus US dollar. And actually, since January, now what happened was, of course, the euro area started lowering interest rates, and the euro currency declined relative to the US dollar because interest rate differentials favored the US dollar. You can see the decline there from about 108 to about 103-ish. It's flip-flopped. It's moving back up. The reason why? The relativity of the United States economy, what's going to happen inside the United States economy relative to what could potentially happen in Europe, we're seeing a shift. Investors are sort of out of favor with the U.S. The United States of America is a brand, and it's being tarnished, plain and simple. That's not politics. That's the stock market selling off 22% because of policies. That's the dollar selling off rapidly. So we're starting to see these big shifts, and they're shifting to higher growth areas. Tariffs are not a high growth area. Economic policy. The U.S. economy will be driven into a recession. Fortunately, however, we're seeing someone back on their heels, backpedaling, realizing, this isn't going to work. Germany. Not only did they pass legislation, they had to do so by amending their constitution, something that's near impossibility here in the United States. They pushed through $800 billion in packages for defense and infrastructure expenditures. Not all this year, but over the course of the next several years. Given this, $800 billion is about 17.5% of Germany's entire $4.5 trillion economy, given one full year. The $800 billion is to be spent over many years, but it gives you an idea of the relativity of what's going on there. So this is a country that now, effectively, if the United States of America does pull out, as they are, this effectively forces Germany, France, Spain, Italy, all of the above, to defend themselves, which means they have to have the capability of defending themselves. Versus whom, however? That's one thing you should genuinely be considering. NATO forces, excluding the United States of America, would absolutely hand it to Russia. Lithuania could march on Moscow right now. Plain and simple. We're lending money to Ukraine to defend itself using NATO's powers, their weaponry, and handing it to them. Europe, broadly speaking, spends an additional $1 trillion in infrastructure and defense, and I'm not sure exactly the numbers on. I know some of that $1 trillion is inclusive of Germany's $800 billion with infrastructure and defense expenditures, but not entirely. So there's an additional $1 trillion throughout the entire euro area. This is a package. Now move backwards to Biden's $1 trillion package, which was far smaller relative to the overall GDP, but that infrastructure package propelled economic growth here in the United States relative to what it would have done without that. Europe and Germany, on a relative basis, are going to invest in themselves and build within themselves. So this will, look at defense stocks. They're soaring, plain and simple. All right, FEZ ETF. These are your top holdings. And I have the companies, and some of these are household names, and the percentages. And it represents, there's 50 stocks in total, and this represents the entirety of sort of the whole European stock market, a lot like the Dow Jones does. The Dow, of course, has 30 stocks. The S&P 500 has 500. There is another in-kind ETF for Europe, which has something like 2,200 stocks. So it's spread out far more so. This one's a little more manageable on a conceptual basis. 50 stocks, I can look at that one a week and get a pretty decent breakdown as to what's going on. But this gives you an idea of the representation. And what I want to do is kind of show some of the stocks and what they've been doing. And I think I only have the top three, SAP, ASML Holdings, and Siemens. Here is SAP, and you can see this goes back to 2020. You can see some growth there as well, and I didn't put a percentage basis, but you can also see right there I put in the revenues, total revenues, gross profits, operating income, and then, of course, net income. You can see some of the things that I'm always looking for are continuous growth in income from for a company on a value investment basis. ASML, again, we're seeing continual increases. These are quarterly numbers here. So you're looking at year over year to kind of get a comparison. Continually, we see these quarterly numbers increasing. Profits are increasing. The stock itself has kind of struggled somewhat, but it's still, since 2020, up considerably. Now, Europe themselves, they don't have Facebook. They don't have Google. They don't have Amazon, the Magnificent Seven, if you will. They don't have those. They don't have the infrastructure for them via legislation. There is some containment that they don't allow these mega maniacs to exist effectively. Certainly there are billionaires over there, but nothing like what we have here in the United States. Nonetheless, you still see continuous growth. Comparing FEZ to S&P 500, FEZ ETF is outperforming S&P 500, plain and simple. Last one, Siemens. Siemens had a huge run up during this period of time. On a quarterly basis, of course, Siemens has seen a bit of a hiccup over the past couple quarters, but relatively speaking, you're seeing the potential of bigger growth differentials versus what we could potentially have here in the United States of America. Now, for now, what I'm seeing, especially today, as I publish this video, is what, Thursday the 24th? The S&P 500 is rallying. Effectively, someone has realized that his policies are not exactly going to work out. He is having to backpedal consistently. He's removing tariffs in certain ways continuously. He initially had huge tariffs on various companies or countries and then decided, I'll pause for 90 days because he realized that not only was it the stock market selling off, but the financial system in general was seizing up with the bond market. The United States of America is the bedrock financial area for the entire globe. And he seized it up. And he is now backpedaling. I don't think we get these tariffs hitting in that 90-day pause simply because he knows it's now disastrous. It's just simply not going to happen. The stock market is responding. They're realizing, hey, this guy, he's all talk. And the stock market is rallying. I think I saw 2.5% for the S&P 500 as I'm recording this video up today. We're seeing a rebound, generally speaking, for the S&P 500 because these policies are not going to go into effect because of the damage that they could have on the economy overall. Great. So the stock market's going to start moving higher. But that doesn't mean that we're going to have necessarily pro-growth on the one hand. On the other hand, we still have 10% tariffs across the board on every single country. China, I think, what are they, 245? Is it 145? I keep seeing different numbers and I don't bother looking anymore. Every other country is basically saying, fine, get rid of the United States of America. We'll just trade with each other. Now, here's an interesting thing. China is now buying their beef from Australia, soybeans from Argentina and Brazil versus United States of America. But that doesn't necessarily mean it's a bad thing. I looked up the price of beef here in the United States, live cattle and feeder cattle, both moving higher. Because the USDA, I think, is no longer involved and they're no longer buying on a bulk basis at a discount, then selling directly to China. Now each farmer has to individually sell off each head. This is my gist of understanding via some communication with some commodity-focused content creators. I'm like, yeah, but what about this? What about this? So that's what I'm kind of keying in on. All these other countries are teaming up and saying, fine, remove them. Let's just work together. Costs will go up across the board because maybe the United States has certain things that we can't get elsewhere. And because of that, this will deteriorate revenues and profits for companies here in the United States of America. On a relative basis, you're looking at Europe, who is pushing forward. And I need to start seriously considering 20 more years and where I can invest and diversify out. And so that's why I'm looking at Europe as one of the destinations. I want to take a look at China. China had bottomed out. China's actually had some issues. They seem to be bottoming out and kind of moving forward from there. So I'm going to take a look at this. In the meantime, I am going to break down, probably in my short form videos, each stock individually the next 50 weeks, breaking down FEZ ETF and how this could potentially be a better opportunity with higher growth potential than the United States of America. Make certain to subscribe. We'll see you in the next video.